It is Employment Friday again, early May here. And we'll go through the usual drill, maybe a little bit of a difference today because I did put out a letter this week. We're going to attach it here. And I'm going to take you through the letter, particularly the slides that talk about and illustrate the rolling recession we've been through. But today is Employment Friday, and looking through the report, everything looks fine, as it has for the last 3 years that we've been calling a rolling recession. What is going on? Well, the more we analyze what's going on, the more we believe that this hoarding of labor after COVID, when it was so hard to recruit labor, is continuing. Companies probably will not let people go until their margins start to erode. And we're seeing for some companies that certainly is happening, others not so. But if we're right that deflation becomes more and more of a theme out there, I think you're going to see more margin erosion and therefore an accelerated move to substitute capital for labor. And we've been doing a lot of work on automation and AI and analyzing how important that will be to the future. Just one other note, since I've just said that, I know that robotics scares a lot of people. Automation, AI, they think about job losses. And in the short term, yes, there's displacement as we figure out new and more efficient ways of doing things with technology. But the history of technology is that it is a net job creator over time. So I never worry about that. And the illustration, the easiest illustration, of course, is what happened when we started to automate the farm. And so with that, I'll start going through the charts. Typically, we do fiscal policy, monetary policy, economic indicators, and market indicators. And we'll do something like that, but it will be in the context of the letter I just wrote. So we'll start with the first slide here. And this is a very important slide. It illustrates the Laffer curve. When you cut taxes, if tax rates are too high, then the revenue actually will increase. Why is that? Because companies and individuals stop using tax shelters and stop trying to avoid taxes. I didn't say evade. That is illegal. I said avoid, figure out ways around the tax system. So here you can see the history of the corporate tax rate. And that is the black line there. And you can see over time what has happened. This goes back to the early 1900s when we first put in place various income tax rates. And you can see there wasn't a good recording of tax receipts until the late 40s. But you can see how low the tax receipts were in the low 40s, how much tax rates have come down over the last 60, 70, 80 years. And corporate tax receipts going to all-time highs. And that's because lower tax rates do tend to stimulate growth, and there is less tax avoidance. You can see in the last Trump term, the corporate tax rate went from something like, well, I guess the maximum corporate tax rate went from 39%, and the average went from 35% to 21%. And in Congress, many people did not want that to happen because they thought that our deficit was already out of control, and this would make it worse. As you can see, tax receipts are up from the 2019 from roughly $200 to $500 billion. And of course, there was the COVID setback there, but so that somewhat distorts it. But tax receipts are up since we cut tax rates. And we think that the same will prove true with individual tax rates as well, especially, and I know this is politically sensitive, but the top marginal tax rate, if that were to come down, a lot of very high net worth individuals would stop using tax shelters. It just wouldn't be worth the legal costs and all of the complication. And so I wanted to show this chart because the chairman of the House Ways and Means Committee, which is where tax proposals start, he mentioned what has happened to the corporate tax rate as a setup for what they are going to propose in this budget. Now, President Trump and this administration generally would love to get a tax package and a budget put to bed by July 4th. I think that the Senate is thinking more like August. The House is thinking they can get something through in May. And I think that President Trump and his team are going to work aggressively to get something done by Independence Day. Lots of symbolism there. And so we'll see what happens. Stay tuned. One of the reasons we think that the odds of a tax package and a budget are increasing by July 4th is we're seeing some weakness in the economy. The GDP numbers came out this week, and we had the first negative quarter since the first quarter of 2022. And so I think the heat is on a little bit politically because we are heading for midterm elections before we know it. The campaign season seems to be already underway, but officially we won't see serious campaigning, I think, until later this year and into next year. Nonetheless, we're in a hot political environment, and economic weakness will hurt the incumbent party. And so I think that President Trump, the Republican Party, will really want to get something through as quickly as possible. So now we're going to go through some of the charts that I present in the letter. And the setup for the letter is the rolling recession that we've been in. Now, many people just don't understand what we're talking about when we say that. But we illustrate that we have been in a rolling recession. And now that we're seeing real GDP turn negative, it did so in the first quarter. We may see much more in the second quarter because we're hearing from a lot of companies during earnings season a little bit of a seizing up in spending behavior, some paralysis, waiting to see what happens with the tariffs and with the budget. So I think we'll hear a lot more talk about recession. And what we tried to show in the letter is while many economists and strategists might be talking about the beginning of a recession, we think that the final two sectors to give way, those that have been holding up the economy for the past 3 years, providing us with positive GDP growth overall and employment growth, importantly, those are capitulating. They are the high-end consumer and government, the first government recession in the last 30 years. The last time we had government contract was during the Clinton administration with Newt Gingrich leading Congress. towards more fiscal discipline. And so here we go. Now, one of the reasons we talk about this rolling recession and have been so vocal about it for the last few years is this chart, the Fed funds rate. Now, what you see here in purple is the actual Fed funds rate, the target rate that the Fed has in place. And you can see it is just starting to tip over after hitting essentially the same level that it did in 07-08 before the great financial crisis. The more important part of this chart is what you see in green. This is the rate of change in the Fed funds rate. And in a 16-month period, in 22 into early 23, the Fed raised rates 22-fold. And that's what this shows. In 16 months, 22-fold. This has never happened in history. We go back to the 70s here, or through the 70s here. But if you take the history of the Fed funds rate back to 1913, you'll never see anything like this. And many people have dismissed this logic, saying, oh my gosh, we were starting from 0.25%. It was such a low rate. This really doesn't matter. It was such a low rate, yes. But from 07, 08, 09 until this massive increase, the world had gotten used to, and especially the United States, to very low interest rates in terms of decision making. If we look at what was happening in the 70s, over time, you can see that people were getting used to interest rates rising, inflation rising, and they were adapting accordingly. There were a lot of inflation expectations built into decision making. There are a lot of interest rate increases built into decision making. That was not true this time around. So this was a real shock, and we believe it started the rolling recession. And we'll get into what that rolling recession looked like. But before we do, just on monetary policy to finish up, the velocity of money is the rate at which money turns over. And you can see it has been in a declining trend since the late 90s, which was the tech and telecom bubble. And which unleashed a lot of technology that over the ensuing 20 to 25 years have been deflationary in nature and helped to hold inflation down over all those years. And then, of course, we had COVID, and we had an absolute collapse in velocity because everyone thought the world was going into depression. So there was an absence of spending. And then, of course, we had massive fiscal and monetary stimulus coming out of that, which stimulated not only the growth of money, but the velocity of money. But if we're right, the velocity of money is going to tip over here again. In fact, it already has sequentially. It dropped in the first quarter. It was fairly flat sequentially in the fourth quarter. And as you can see here, it's at about 1.4% on a year-over-year basis. I think that's right. But dropping sequentially means that there's going to be pressure on the year-over-year number, which will pull overall velocity down. That's a real break on economic activity. And so the Fed does not have much room to maneuver here. The market is beginning to understand this, and it now sees roughly 4 cuts, I think, this year in the Fed funds rate. Now, what did that very sharp 22-fold increase in interest rates do? This is what we're talking about when we say rolling recession. It shut down home sales. You can see, and the actual number, peak to trough, existing home sales dropped 39%, and they really haven't recovered. Why is this? Well, of course, people are trapped in their homes with 2 to 3% mortgage rates. If they rolled into a new home with higher prices, because prices have increased during this period, their mortgage rates would double or triple, and in some cases quadruple. They can't afford to do it. So housing has been in a recession. Auto sales. So autos are a pretty mature category. And here you can see auto sales after the bump during COVID. Autos were hard to get, production stopped. They flatlined in the 15 to 16 million range, which is subpar relative to past cycles where they flatlined closer to 17 to 18 units. You can see very recently they had a pop. What is this? This was pre-tariff buying. And according to auto analysts, we're beginning to see the unwinding of that now that tariffs are in place. And some of them actually are being taken off. So we have auto analysts expecting this number now to drop back to the 14 to 15 million unit pace. So that will be a drag on activity in the second and third quarter. Look at what happened to manufacturing in the U.S. The spike in interest rates in 22 drove manufacturing down. Now, this is a diffusion index. So 50 is the demarcation point between expansion and contraction. And you can see we've been contracting since then. Manufacturing has been in a recession. And when we say rolling recession, housing and manufacturing never got out. They've stayed down. Then we can go to capital goods. Capital goods, likewise, those decisions, even with AI and all of the power investments, so data center and power investments that have been booming here over the last few years, even with those, we have been nowhere. Capital spending, broadly based, has been flatlining for the past few years, another form of rolling recession. Here's what's happened to small business. So this is their optimism index. And you can see as interest rates went up dramatically in 22 and early 23, the small business confidence collapsed. And look where it landed. It landed below COVID lows and closer to where we were in 08, 09 and coming out of 08, 09 as the world seemed like such an uncertain place. The big spike here was the election. In the election, NFIB optimism boomed, but now it is unraveling, and we'll get another reading in mid-May. And according to some estimates, the small business optimism index is back to where it was with the increase in interest rates. Why? Of course, tariff confusion and chaos, and credit conditions tightening even more. Now, they were tightening for small businesses all along. They just couldn't get credit. And once again, now that credit spreads more broadly, and I'll show you this later, are gapping out, the credit conditions have become very difficult once again. And then here, this is certainly some drama, another sentiment index. Here you can see in 22 and especially, you saw the collapse in confidence, and it was all three income categories: top third income earners, bottom third, and middle third. They all collapsed at the same time. You saw the low income earners really never recovered. And look where we are again, below COVID and where we were in 08, 09. Actually, low income earners' confidence today is below where it was in 08, 09. And you'll notice after a little bit of a rebound, and certainly the high-end consumer performing well, in April, we saw the high-end consumer sentiment. Again, the high-end consumer had been holding up consumer spending. It came down dramatically. Again, I think the stock market turmoil was a big reason for that, and it is probably hurting spending now. And look at how low this is. You really do have to go back to 08, 9, 10, 11, when the consumer just and remember, this is as GDP is not contracting, except for that half a point or a third of a point in the first quarter. And employment hasn't collapsed. This last employment report, when you include the revisions, was a little better than expected. Again, this hoarding of labor, but the consumer isn't feeling really good about this. And then just to give you another peek at what the consumer is thinking about business conditions, it's off the charts negative because of what's going on with tariffs and so forth. There was another chart I didn't include, but the consumer's expectations for unemployment is at recession level highs. And of course, that's related to what they think businesses are going to do. Here is the yield curve. Now, in the letter, we illustrate, or we describe, this chart illustrates how typically a harbinger of a recession is an inverted yield curve. You can see the shaded areas are recessions, and before each shaded area, the yield curve has turned negative every time. It even did in 2019 before COVID, but it did so just for a month or two. But look, it has been very negative for a long period of time. Now it's moving positive. Every time it has moved positive, it is in a recession. And that's why I think we'll hear a lot more people talking about recession, economists, strategists, talking about recession and thinking about how long the average recession lasts. Whereas you're going to hear us continue to say, we've been in a rolling recession, and this is probably the end of it, with high-end consumer coming down and government in recession for the first time. We also believe that that the yield curve will continue to create surprises going forward. We have been struck over the years since 08, 09 that this has been a downtrend in the yield curve. Normally, massive fiscal and monetary stimulus would have gotten that 21 yield curve back up into the 200 to 300 basis point range. Instead, it stopped at 150 basis points. And we wonder if we'll even make it there this time, because we think there is a deflationary undercurrent that the yield curve is beginning to pick up on. And it's being caused by what we believe is the convergence among all of the technologies that are evolving today and have entered prime time. You can see how many of these technologies are evolving, how interrelated they are, how central AI is. And you can also see something interesting here. Trueflation CPI versus the US CPI. Now, trueflation CPI tends to pick up on inflation before the US CPI. 3 to 6 months before. And you can see here, even with all the tariff turmoil, inflation indicators, this one at least, are pointing down. The last reading, I think, was 1.37%. Versus the CPI, which is a little over, I think it's at 2.5%, a little over 2.5% right now. That's the green line. Trueflation is the purple line. It's pointing down. And as we've been saying for some time, burden of proof has been on us because we did have this flattening out for a while in the 2 to 3% range. But we thought it was going to resolve to the downside. And here it does seem to be doing that. And we wouldn't be surprised to see negative inflation, just like we saw right after COVID and in late 2015, or no, that would have been early 2015 when there were some real scares about China exporting deflation. We think some of that is going to happen. China exporting deflation as its economy is being hurt here, I would say, rather badly by the tariffs and the technologies all coming together and creating a productivity boom, which we think is going to lead us out of the recession and create a really virtuous cycle. Productivity boom, unit growth going up dramatically, and inflation coming down, maybe into deflation. So we also explain in the letter that our kind of strategy, any innovation-based strategy not wedded to the broad-based benchmarks, has had a very difficult time facing 3 major headwinds during the last 4 years. One was interest rates. We think they're coming down. The second was the concentration in the market towards, a very few names. And those tended to be very cash rich, larger cap names. We think we're at the end of that headwind as well. And we'll see as this correction in the market turns into a recovery, we'll see if this is what continues to happen. It started to after the election. The tariff turmoil caused a bit of an upset. But I think coming out of this, especially if we're right, that inflation's coming down, the economy's going to recover nicely, productivity leading the charge, thanks to these technologies, we think this headwind will dissipate as well, and that the bull market will broaden out. I would describe the bull market through 23-24 as I know anyone wedded to the benchmarks won't agree with this, but as an unhealthy bull market. It was not broad. In fact, it has never been less broad. It was worse than the depression level concentration as measured by this Goldman Sachs study. And now we think it's going to broaden out into a healthy bull market, as it did from 32 to 36, 39, into the 40s, the late 60s. The exceptions were 73 and 2000. They ended up in a bear market. But even 09, which I remember very well, it broadened out into the market recovered, and the recovery was very broad. So, and then the last chart in the letter, we have more charts here and we'll go quickly through them. But the last chart in the letter talks about the third headwind. So the first was interest rates, that's gone. The second was concentration in the market, fear causing a shift towards a very few stocks, cash rich, large cap. And we think that's dissipating. And then the third is certainly the valuation headwind. And you can see innovation-based strategies are at near record low valuations. When I say record low, this is the history. This is the history of ARC's life, but innovation-based strategies broadly are selling at a very low premium to the S&P 500 as measured by enterprise value to adjusted EBITDA. We worked with S&P 500 to adjust for stock-based compensation and R&D, both the S&P and the various innovation strategies. And you can see very, very modest valuation premium. The average over the life, or at least ARC's life, on this metric is roughly 90%, I think. Taking out COVID, the COVID distortion, it's 75%. So innovation, we would say, is on sale. So let's finish up these charts quickly here. This is from Big Ideas 2025, and here are our expectations of what the broadening out of the market will mean. You can see that the Mag 6 from 2019 to 2024 tripled in market cap, whereas the rest of innovation, and we would say truly disruptive innovation, lagged badly. It was only up 30%, not even a double. You can see that we expect the Mag 6, not all of them. We worry about Apple, as we've told you many times, somewhat Alphabet as well, but all of them have will be touched in some way by disruption to the traditional world order. Nonetheless, we think they will deliver good returns over time, but we do think it's now time for truly disruptive innovation, this broadening out of the market to reward the true disruptors. And so we expect more than a tenfold increase during the next 5 years in the market cap of those. And you can also see the rest of the market, we think, which really represents the traditional world order, will not see much appreciation, if any, on balance. In terms of the bond market, here's the very long term. We were in a bull market for 40 years, and we've come out of that bull market. And the question is, where now? And I want to show you a few charts. We think that maybe we're in a new normal that will be in the 2.5 to 5% range as we go into a world of perhaps stronger than expected unit growth, but lower than expected inflation. And if you look back at the last time we were in such a period, massive innovation, the 50 years that ended in the roaring 20s, what we saw was an inverted yield curve. Most of the time averaging 100 basis points, but short rates mirroring nominal GDP. So if nominal GDP is in the 4 to 5% range, maybe that's short rates. Inverted yield curve would be 3% to 4% long rates, and so forth. Just an idea. Here you can see a lot of people think we're in this massively inflationary world, and we're just not, as measured by commodity prices. You can see we are today where we were back in the 80s, back in the 90s. The real inflation was when the Fed in the late 90s responded to long-term capital management imploding, to Y2K, the fear of that shutting down the global computer network, and then finally the tech and telecom bust. So the Fed drove a really inflationary policy back then, but it has not since then. We had, of course, the supply shock during post-COVID and during COVID, but we've settled down since then. And this next chart is a real eye-opener. We've been presenting this for quite some time now. And you can see how tightly correlated the ratio of metal prices to gold prices in the purple line there had been to the 10-year Treasury yield. Such a close correlation, definitely after 08-09, until the Fed started raising rates this time around. And if you'll remember, we've been presenting this chart for quite some time. Look what's happened to it. We thought that the truth would be somewhere in between, that long rates would come down and this ratio of metal prices to gold would go up. And you can see that has not happened. Instead, the gold price has gone parabolic, at least compared to where it's been recently, and the metals price has not. And so you're looking at this, which tends to give you a good sense of global economic activity. It's really the purchasing power of gold. And what it is saying is there's a real problem out there. This is worse than COVID. This is worse than 08-09, worse than the tech and telecom bust. What could it be? It could be China. It could be emerging markets impacted by China. But it's not normal. And what we do think, and let's go through a few more charts before we conclude on what we think. Here, this is market and economic indicators. We've moved kind of into that section. I've mentioned before that there are some bears out there who really believe that we're going into an inflationary bust, much like we did in the 70s and early 80s. And they feel vindicated because you can see what's happened now to the S&P price relative to the gold price. It's beginning to look like it's breaking down, just like it did during the 70s. But there's a little bit of a contradiction here. The same bears on this basis have to face this chart, which is the S&P relative to oil. Now, as you can see in the 70s, this too collapsed, but it's not doing that right now. It's actually moving in the opposite direction. The gold price the oil price has been going down as the S&P has been flat to up in here. And so we have a contradiction. Now, we think that the oil price, which is coming down, is a massive tax cut, is going to feed into inflation, is going to be very good for the market, and that the ratio of the S&P to gold will reverse, that the gold price will settle down and the S&P price will go up relative to gold. Again, let's see what happens. We have an open mind on this. And if we're right, then we think that the global economy will improve and that metals to gold price in ratio will reverse. And maybe it will do so at the same time that interest rates are coming down as the Fed cuts short rates. Another indicator that keeps us honest here is these are credit spreads. It's the ratio of high yield bonds to the 10-year Treasury yield. And you can see low by historical standards, but starting to spike up a bit. And as you can see, this is what happens during recessions. It does spike, tends to go up before recessions, and then spikes during a recession. So we'll keep an eye on this one to see if this rolling recession turns into a rolling recovery and prevents a big spike. And then finally, always like to talk about Bitcoin to gold. And again, gold going parabolic did take this ratio down. But you'll notice that it did not break the uptrend that is in place and that we think will remain in place. Bitcoin did act more as a risk-off asset. A risk-on asset in the market's recent correction. It behaved like the NASDAQ, unlike gold. But we believe that it was just correcting to this trend line because the Bitcoin price went up so much more than the gold price last year. So we think that this trend line will continue to move up if we're right that we're moving back into a risk-on environment. Now, the gold, why did gold act as risk-off, but Bitcoin not do so? I just described one reason. Bitcoin was way ahead of the gold price, so that is one reason. But I think the other reason is we weren't in a financial collapse. We were like 08, 09, and the banking system was or the counterparty risk in the banking system was not called into question. So we think the flight to safety into gold was more of a, hey, let's readjust and get this back into some kind of trend line. So with that, I hope I've conveyed we're really excited about how the market is beginning to shake off three headwinds: interest rates, convergence or narrowness of the market, and valuation. And we think that we're being set up here for some important surprises to the upside, as many strategists and economists worry that we're heading into a recession. We'll be talking more and more about the productivity-driven recovery that will spell the end of the rolling recession. So with that, we'll know a lot more by this time next month, and we'll go over many of these charts once again to see how the market is interpreting our view of the world, which you will see in this letter, in the letter that we have attached to this webinar.
节目最后，如果本期资讯对您有所帮助，请您点赞、评论、订阅并打开小铃铛，这样您就不会错过本频道的最新内容。谢谢。